Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey, and this week I'm joined by Zacks Chief Equity Strategist, John Blank, to talk about our outlook for 2022. It's just a few weeks away now. Where do we go from here? What will the economy be doing? Is recession on the agenda? Let's hope not. And what will happen with the stock market? So, John, things are looking pretty good going into 2022. So I wrote down a list of what is working. The job openings are at all-time highs. The quits are at highs. The weekly jobless claims have fallen to an over 50-year low now, under 200,000. We saw that 199 a couple weeks ago. The ISM for services is at highs. That's most of the economy. Unemployment has fallen back again, down to 4.2%. The stock market's been a little bit shaky here. Now, we're recording this at the beginning of December 7th. And right at the end of November there, not looking too good. We had a pullback, but now we might be back at all-time highs. Apple was just hitting a new high. So all those things appear to be working again. And now it looks like this Omicron variant might not be that bad and that the vaccine does work against it. So some fears about that have receded. Is this like a Goldilocks going into next year?
Well, I'll tell you what, context is a meaningful subject in economics, and the third quarter GDP report was 2.1%. The second quarter was 6.7%, and what people think about the fourth quarter is anything from 8.5% to 9.5%. So you have very strong readings on the fourth quarter. But if you blend the three together, let's take 2 and 6 and 9, that'll be 17, and then divided by 3, we'll get to 5.7, 5.8%. That's really what's going on.
Okay.
Yeah, so you say to yourself correctly, Tracey, as you pointed out all kinds of secondary variables, a constant rate of growth at 5.5 to 5.7% in the United States is quite strong. And we're seeing that we've pulled ahead in many categories of vis-a-vis our peers in terms of generating jobs, recovering lost incomes, reaching new highs with GDP, and frankly, the stock market in the United States is singularly better than anywhere else in the United world right now. I mean, there's very few other parts of the world, most people understand this. Canada's doing somewhat okay, Russia's somewhat okay, the Saudi oil countries are somewhat okay from a stock market perspective. Basically, everywhere else stinks. So from a wealth perspective, from a GDP perspective, from a jobs perspective, things are pretty good, as you mentioned. Okay. And then now we found this morning why the stock market's going up. We're talking Tuesday, December 7th. Obviously, the Chinese announced they are signaling a rate decrease. So weakness in China creates monetary liquidity in China, which happens at the very moment the Fed's going to pull back. Because all the good news here has to be met by a tightening Fed. But if it comes with a weakening China that is being acknowledged in the central bank context with more liquidity there, that's another, in a global context, a very Goldilocks scenario, right?
Right.
Because money doesn't care where money comes from. Money cares about how much money is coming into the market, right? Chinese money, European money, Japanese money, U.S. money, doesn't matter.
Okay. So you do think that the Fed will be tightening next year?
Yeah, I mean, Tracey, let's keep our minds around the fact that when we entered this pandemic, we were at 3.5% unemployment. Now, at that time, 3.5% unemployment was built out of a numerator and a denominator, right? The numerator is obviously how many people were unemployed, but the denominator was how many people were in the labor force. In those days, February of 2020, there was 164.4 million people in the labor force. Today, speaking on Tuesday, December 7th, looking at October and November macroeconomic data, you have 162 million people. So 2.4 million people are no longer in the denominator, right?
Okay.
So what this does, obviously, it has fractional, a smaller denominator makes everything seem a little different, right? Because you got to remember, 2.5 million people simply are not going to work now, right?
Correct.
But from the Federal Reserve perspective, monetary system perspective, it doesn't matter. So I would point out a couple things. One is there's probably a lot more slack than that number indicates. And it's probably true that the Fed doesn't care. And if we get down to 3.5% here within the next 3 to 4 months, with that 400,000 or 500,000 job ads a month, we're going to definitely do.
Right.
Then this gets to the point that I've made with a lot of people who simply are focusing too much on the consumer price inflation floating around 5-6% is, even if that goes to 4 and we're on the back end of the supply chain issues, that is still above the Fed's mandate on inflation. And more importantly, and I'm using the word more importantly because they have a dual mandate, if they have a 4% CPI or a 6% month, doesn't matter, they violated that mandate, and in 3.5 months, 4 months, they're going to violate their unemployment mandate. And so then if you're the FOMC and you're under a statutory mandate, right, that means that you have to do this. You have no choice, Tracey.
Okay.
So you are in at March and, you're pretty hawkish. I would tell you, I looked at the CME Fed funds data, and the basic idea for most people is 2 to 3 hikes next year with one start in May or June. And there's 85% probabilities that we have a hike by July now. One, at least.
85%?
85%.
Wow. Okay.
So what you can think about here, we're going to have the December 14th, 15th meeting next week for the Fed. Powell has already announced that he's on board with moving the taper forward. What he would like to be, now that he's elected to be the chairman again, is get the taper out of the way by March, right?
Okay.
Because you got to remember, he wants to enter a true tightening phase once the statutory mandate criteria is met, right? Because in a historical perspective, then Jerome Powell can argue somewhat more sanguinely that he did become less accommodative when his statutory mandates were in play, right?
Yeah.
It would be very borderline. It would be very probably late, but it would be accurate. Now, if you look around the world, most people don't do this, but I do. I'll just tell you how late he is, just to show you the number of countries that have already raised. Now, this is probably a month ago. I probably can add another name or two, but Sweden, Norway, the Czech Republic, Poland, Russia, Peru, Colombia, Chile, Mexico, Brazil, Argentina, and of course, South Korea. At least a dozen countries have already raised policy rates, Tracey, not got done with tapers.
Yeah.
So other thing people need to understand is the COVID is the factor behind the consumer price inflation rates that the world is experiencing, not just the United States. And a dozen or so banks are already hiking rates. So there's another data point that cannot be ignored. It's certainly not being ignored in the dollar markets of all these exchange crosses. And it's going to play out in terms of a data point within the Federal Reserve debate here next week. And they're all going to say, I would say, they're going to give Powell unanimous hands down play to start basically doubling the taper, getting it done by March. And I think that the thing you got to understand about this, and you're pretty good about this, Tracey, is that's probably what's already priced in.
Yeah. And I'm thinking most of the weakness that we've seen in the growth stocks is pricing in that reality that they're going to double, the drawdown of the taper, and then we are going to get the rate increases.
Right. And so you pointed out, Kevin Cook just pointed out, he's been trying to time the biotechs. The biotechs are kind of the canary in the coal mine and this whole taper pulling in. So you can get the answer wrong. It could be bullish when they announce they're going to go this next week because everybody's already figured out it's going to happen.
So do you think this sell-off in the more extreme growth names like the biotechs and even the PayPals of the world is over then? It's already been priced in?
Well, I think it's over in terms of severity, but I don't think these recover. Like I was looking at NVDA. NVDA is back to where it probably should have been before people got too euphoric. The basic problem with the Cathie Wood scenarios for these companies is they're multi-year, if not 2-decade transformative companies. And, it's going to be a long road to hoe and probably hard to pick the winners out of who gets there.
Okay.
So I think the markets are probably being accurate here. They probably will not go up. They'll just go sideways, right?
Right.
I could see a bearish rally here off the lows that takes us into some kind of more comfortable feeling for a few months, and then they roll over again and go sideways again and go up or down for another 2 years, right?
So where will the money go once people realize that, if your scenario plays out? It's going to take a little bit of time for all those who are the buy the dippers and all that to realize it's going to go sideways. And then where will they go?
This is
what's the area?
I'll tell you a couple ideas. One is I think you've got to watch the Russell and the mid caps.
Okay.
If they break out, that will be one signal where the money's going. And then I'm really agnostic about value and growth. I think people are going to see both of those do fine in this environment. And I do think once the small and mid caps in the United States definably break out of consolidation, if they do, then the international stocks, which are so beaten down, are going to get lit up.
Yeah,
the European stocks are dirt cheap. Chinese stocks have been beaten up for a couple of years now, 3 years, 4 years now. And sooner or later, people will start bottom feeding and moving some of the money into those markets.
Okay, I've been hearing
again, Tracy, playing the big cap names in the United States and playing the ETFs has been pretty solid advice.
But
picking stocks, I don't know. You tell me how you think that's going to play out.
Well, is the Fang Man trade, or the Fangs, whatever you want to call it, is that basically done? And I ask that because Amazon has really gone nowhere for the last year. That one has been done. It's gone up, 5, 6, 7% or something in the last year. And that's like nothing compared to what the prior gains were like for that stock over the last, 4 or 5 years. So to me, Amazon is already kind of telegraphing what may happen with some of those big popular Fangmen type names, many of which aren't exactly overvalued here, but might just be kind of, not going to be where the catalyst is for the overall market in the next, 12 to 18 months.
Yeah, I got to believe the chip stocks are a better play. The Microns, the Western Digital's, the Qorvos, AMKBY is another name I've looked into that's got a good story for the supply chain disruption. Texas Instruments, ST Micro, these types of names, because there is going to be this huge surge in CapEx and continuing electronic use in cars and all this stuff for electrification, and I just got to believe that's where you want to be.
Should investors also be looking at the infrastructure plays? I mean, we passed that huge infrastructure bill, and now nobody's even saying anything about it. And clearly, it'll take a while for that money to work into the economy and for all the projects to get bid out and all that stuff to happen. But I haven't really heard anyone talking about, whether or not they should own some of the infrastructure plays like a United Rentals, or I don't even know, some of the EV charging companies and things like that. Like, is that an area that, might have some value here going forward?
Yeah, you got to think about that. I think, again, that the Politicos and the Axioses of the world will tell us about the letting of the contracts for infrastructure. When the Axios and the Politicos start to announce who gets the contracts, and then we find out who those people subcontract to, is when I think we'll get the bids in play for that.
Okay.
Markets, the problem with this type of thing is, when does it happen and who gets what? So, you telling me, hey, I made $100 billion. I'll be like, God, that trade is unreal, Tracy. And then I'll be like, I don't know what to do about that. If you told me, I went to, Williams-Sonoma, I spent $50 billion of it, I'd be like, well, I know where to buy that stock, right?
Yeah.
So I got to know what you're going to do and who you're going to do it with. And then I start to, and I think, pre that, Axios and Political will tell you who's doing the business, who's getting into the door and all that stuff.
Speaking of Williams and Sonoma, and even just like the housing market in general, that was real hot in 2020. The housing market has remained strong here in 2021, but some of the stocks, not so much, even though apparently some are hitting new all-time highs, but they haven't done that much throughout this year. What do you see for the housing market going into 2022, especially if we're all in agreement that the Fed might be raising and those mortgage rates might be rising a bit here?
Yeah, you still got to think the supply response to the high prices is going to make a bull market for stocks that are in the supply response businesses.
Okay. So you would still be a buyer?
The KB homes,
okay.
We've had the lumber groups finally get out of their bubble, but they'll probably be good. And, some of the plywood groups and the insulation groups and the carpeting groups.
So you still like the home play?
Plumbing groups.
Okay.
Air conditioning.
Yeah, and a lot of them remain cheap, even though they're, well off their lows from last year, obviously.
Yeah. But when you have, we have a record high price response, just being an economist, the first thing you would expect to do is the suppliers will continue to pour supply into the market until they bring them down. So you say, how long does that take? Well, it's a regulatory thing, a builder construction thing, and et cetera. But, if you just want to be an economist, that's what you're going to get a bull market for, right? High price for more volume.
We're going to be checking out some of those home builders then. You mentioned a couple of KB Homes is KBH, Lennar's LEN. Toll Brothers is about to report earnings right after we record this. So we'll see what they say. That's on the luxury side. TOL is the ticker there. Those are some of the big ones. Pulte, the other one, PHM. They're the largest publicly traded home builder. So, yeah, there's a lot. And they're all cheap. They all have P's under 10.
Yeah, and Mohawk, ticker MHK. Right? Okay. You can pick up Mohawk on a pullback. That's the carpet guys. So aircon guys and stuff like that.
Right, for sure. All of the secondary, or even like Whirlpool, WHR, people still waiting on their appliances for months on end. I have my fingers crossed that none of my appliances die right now, because I really don't want to deal with having to try to order anything new. And even just to get like a maintenance guy in here to look at it is hard enough, let alone getting something new. So keeping my fingers crossed on that. What about the auto stocks? Everybody still wants a car. That's still hot. That hasn't died yet. We haven't had peak auto, I don't think.
Yeah, here's the problem. I just pulled this up this morning. Motor vehicle and parts job in November fell 10,000.
Okay.
It rose 20,000 in October, and they fell 3,000 in September. So you're finding that basic employment, so the production in the motor vehicle parts is staggering around and maybe negative most months because of the parts issues.
Right.
So the problem there is they just simply don't have a product to deliver, right?
I know.
And then that reaches into an electrification story here that continues to ramp itself out over the next years, probably more like a 5-year span than the next year. So short term, you've got to get parts issues, chips in particular, ironed out within the motor vehicle industry, which, by the way, brings me back to the chip companies as one of the solutions, because they'll start making their own chips now in the United States.
Right.
And then that will slowly be reflected in the employment for motor vehicles and parts jobs. And that's something you can watch as an economist, is when those jobs start getting added, that's when the supply chain's over for the auto companies. And that's when probably analysts will start upgrading those companies.
Yeah, I know several of the big parts guys like Magna or Lear, they make the seats. LEA, I think is the ticker for that one. They've had to cut their full year earnings outlook because of the supply chain issue, not because of demand, obviously. But
this is probably the case. And so then you say, well, when do I time the bottom in this whole thing? Good luck with that.
Right.
And the problem here is, you really got to wait for the charts to get very constructive, because the forward-looking guys will tell you what's going on and start throwing the volume, the price up on those charts and tell you. Just wait. In my opinion, on those types of things, you're wanting the to come out of the charts on those types of companies. So don't buy the bottom. It's going down. Just it can go down for a long time.
All right, I'll keep some of those on my wish list. What about the travel stocks? These are hot. Everybody likes them, even the airlines, but the cruise ships, the hotels, a lot came down sharply off of the Omicron news, and even just some of the restrictions that have been put on over in Europe now because of the Delta outbreaks that are going on over there. Could some of these be deals going into next year? Because I noticed we just had a outbreak on a Norwegian cruise liner that was going back into New Orleans, and nobody panicked. Nobody freaked out about that they were having an outbreak, and even the stock didn't really do anything on the news. So have we reached like an accommodation with COVID now with these travel stocks that, this is a buying opportunity since they have pulled back on the Omicron news, and that next year we are going to continue to see more of the reopening. People want to travel. I just saw some data from one of the airports that they're publicly traded down in Mexico, and the one that owns a couple of the Mexican airports plus Colombia and Puerto Rico, I forget which one of them it is. They split up all the Mexican airports into a couple different companies, but they had higher than November 2019 numbers for November 2021. They had more on the international side. They had more international visitors coming in to their airports in November 2021 than they did in 2019. So that's a positive.
Yeah, again, this is where it gets tough because how much of this is priced in or not, right?
I don't know, right? But they have pulled back a lot of these stocks. Yeah. So is this a buying opportunity in them? I don't know. That's what I'm asking.
Yeah, I think this is a big question mark in this area. For a lot of things that are going sideways, this is the problem, is you might just be in dead money from a trading perspective, but get the investment call right.
Yeah.
So you just got to think about your horizons, because it's going to be very hard to figure out what's been priced in here. So bad news can be good news can be bad news, And then you're like, I didn't understand that, and it's like, well, this is the point. I mean, Norwegian cruise lines can have a huge COVID operating, the stock goes up 5%.
Right. So it sounds like you're not a fan of the travel stocks.
I just think they're probably better places to look to put money to work. I mean, have I bought any travel stocks for large cap trader? No. I have plenty of ideas in the tech space, large cap tech space, that I find attractive at these levels. And industrial names like we've talked about, that I think there's a CapEx boom that is easily cyclical and playing out in some areas that can be tagged down, and those stocks are overplayed. And I think, why do I want to bother with Norwegian cruise lines? It's kind of the way the Buffett looks at the airlines. I mean, people can get these as trading calls, but, all we need is some really weird news that nobody thought about, which is really easy. I mean, Russia invades Ukraine and starts shooting planes down. Well, that'll take the, I didn't think about that. I thought it was all about COVID. Well, no, it was until, the Russians started shooting planes down. And then you're like, I should have thought about that. Well, you're not going to think about that. Putin's not going to call you and say, hey, I'm shooting your plane down over Paris tonight.
Yeah, there's definitely a lot of things in play with the China.
But just imagine Putin sends a missile and drops a 747 over Paris. But just one thing, one time, it would be a deal killer for like 2 years.
For sure.
By the way, he's massing troops on the border of Ukraine as we speak, right?
I know, yeah.
So you say, that's just really incendiary, John. That might not happen. I agree. But, again, crazy stuff does happen in any given year, and this is the problem with these stocks, is you get on the wrong side of that thing. So I think travel stocks, in my mind, are these technical plays where you wait for the real stupid thing to show up and then buy them.
So large cap tech, you still like?
I like large cap tech. I like large cap industrial names with core links to electronics and, to some type of sophisticated play.
What does that mean? Like, can you give an example?
Yeah, like Wesco, WCC. Wesco they bring in 1 million electronic parts from 30,000 suppliers to kind of be the, one-stop shop for putting up a really sophisticated plant or building or whatever. So is that going to work? It's a 13 times earnings, makes $10 a share. Based in Pittsburgh, probably overlooked stock, high beta, you pick it up when it blows up every once in a while. Yeah, I'd take that over, Norwegian Cruise Line.
Well, that's some good advice, because I do think people fixate a lot on these kind of trendy names. And
that's the other thing you got to worry about, as you pointed out, is, Cathie Wood and the whole downward trend that has emerged in the shorting game to blow up the Rokus and the DraftKings of the world.
Yeah.
So where does that crowd go when they blow those stocks up, right?
Right.
And that's when I don't like the travel stocks either. It's just that, once those crowds blow those stocks up, they'll move to the next level of like whippy stocks, right?
Correct. Yeah.
And then all of a sudden, Tracey got really bullish and bought insider trading stuff for Norwegian, and, the shorts pile in, and all of a sudden you're selling things at 20% out because you didn't think about, the shorts got in.
Right. So on the other trendy areas, do you see any blossoming trends in any type of a sector for next year? Like, for instance, a couple years in and out, they kind of go in and out of favor, but we've had like hot periods of the cannabis stocks. They seem to be kind of out again, I think, right now. I don't know. I lose track of the cannabis. But is there any industry like that we should be, looking to get in before it becomes the trendy area, I guess, is what I'm asking?
Sort of think the opposite. I mean, one of the things I was looking at this morning for my new Economics Monthly is the names that are providing, like, the cybersecurity and data protection, which is the hot area now that we're all working at home, right?
Right.
So let's talk these names. QLYS, QLYS, Radware, WDWR, Cloudflare, Palo Alto Network. So just as we're doing this, I'll pull up Radware, and I don't have any idea I'm going to pull up here, Tracey, but let's talk about Radware. So I'll go to Zacks.com, and I'll type in WDWR, Radware. Okay, here we are. The value is, the stock's at $30 a share. It used to be at 36.
Okay.
Forward PE is 37. Market cap of 1.4 billion. Expected earnings on the February the 9th, and current year estimate is 81 cents a share on $30 in earnings. So If I look at it, it's tanked from 36 to 30. Do I like this stock?
Doesn't seem that cheap to me.
Well, if I told you now next year's got $1 in earnings, you're paying $30 for it, you say what?
That's not as bad if they can make that for next year. It's a little more attractive.
Yeah, I would say, this is a name where I think, you know what? I probably wouldn't buy it right now, but I would put this on my radar screen, right? Let's do Crowd, CRWD.
That's really pulled back, I know.
Yeah, so CrowdStrike, again, this stock got blown up.
Yeah.
It's 194 now. It was 280. Now, you're going to love this. I mean, projected earnings are up 115%. And that takes you from 58 cents a share this year to 91 cents a share next year. So you're paying 91 cents a share. It's $200 to buy 91 cents a share of earnings. So in a value investor podcast, what's the answer on CrowdStrike?
Well, I'm still passing on that. It's still too expensive for me, but I have been watching CrowdStrike. I did put it on my watch list during this sell-off. Yes,
that's the right answer. CRWD should be on your watch list because it's blowing up and it's got some interesting potential. PANW. Right, that's a big name. Palo Alto Networks, $500 a share. Forward PE of 70. However, they make $9 a share in earnings next year, Tracey.
Still pretty pricey.
Yeah, this thing moved
for the value.
I mean, back in late 2020, it was $250. It's doubled in a year. This one I shoot down. I would never look into Palo Alto Networks. This stuff, all I can see is losing $100 a share really quick. Because just like Crowdware and Radware, okay, Palo Alto Networks has the same story. They're making the money. They're probably the better company. But this is where the shorts can pile in on a stock like this, right?
Yeah.
So I personally would be putting Radware and Crowdflare on my list of things to watch for a value investor, and I would basically not even bother with Palo Alto Networks. So let's do one more name in this hot list. QLYS is QLYS. 130, 126, forward PE of 40. Pretty constructive chart. It's an interesting one. 340 a share next year on $120. So, not terrible. And you think, okay, would I buy this? I win on a pullback for this one. It's just too strong a stock. I might look for 100. If it got to 100, I'm on 126 or 110. I might buy the stock.
Okay.
But this one's an interesting one. From a value investor perspective, it's a stronger name than Radware and Cloudflare, and it's got a really nice chart, Tracy. They beat every single time for 5 years.
Yeah. Yeah, some of these have real good.
Would you buy this now when it topped out at 140 and now it's 130? No.
No.
There's not a value. But if QLYS goes to 110 in the next year, you would jump on the stock.
Maybe.
It never misses. You look at the earnings trends on the 5 years they're showing on Zacks. It's super, super positive, always going up like we like. Pretty attractive play here for a long-term momentum play in an investor value perspective once it sells off.
Yeah, we'll see. I have a lot of these types of names on my watch list in various sectors of the hot growth names because they have pulled back, but some have not pulled back quite enough for me yet.
Yeah, I think that is basically the right answer here is with getting back to economics, with the Fed pulling down, the taper. There will be panicking periods here where you could buy in on these names. And the point is to study the QLYS, the Radware, the Crowds, and the Palo Alto now so you understand them better when the world falls apart and I knew that was going to come.
Yeah.
Because these are names that are, this is the cybersecurity stuff that's not going away. This is the new world that I think people should be paying attention to a lot more, right?
Okay. Yeah, me too. Yeah. So for a final question, Warren Buffett's sitting on $149 billion in Berkshire Hathaway. Do you think he too is just waiting on the sidelines to get into some of these stocks and or buy out some of these companies on a bigger pullback? What do you think is going on there?
We know Charlie Munger is here in Santa Barbara all the time. He's out in Pasadena. He's a big benefactor of science and technology, at a research level, right?
Huh.
And we know Buffett has all these younger guys that he somewhat trusts now, right?
Right.
So the real mystery to me is why Buffett has never decided he can understand the chip stocks. Look, can Buffett understand Micron? Seriously. How hard is it for Buffett to understand Micron? And Charlie Munger doesn't know how to tell him what Micron does and how it works.
Those are the easiest ones.
Yeah, I think the really big, easy ones that are values. Come on, Micron's a value stock. Buffett can figure Micron out to take a $30 billion position in Micron. I don't know if I'm not sit down with Buffett and tell him about NVDA. Right? Because he'll have a heart attack.
Right.
But I could sit down and try QRVO, WDC, MU, and TXN and get him to understand at least MU. And this is what I don't get about Buffett. He's always like, I don't understand tech. Really? There's an industrial, manufacturing element of this. You're actually pretty skilled at this stuff. Go and check out some chip companies. Go and walk the floors, realize you understand how this works, and start buying some of this stuff. Not that Buffett's listening to me, but if he is listening to me, that's what I'm telling him to do.
That could be the main area. I don't disagree. So we'll see what happens. But he's got to do something with it It can't just.
He's got to quit with the whole "I'm a 95-year-old guy and I'm a dope about this stuff." He's not a dope.
Right.
He can figure it out,
or at least shove some of it over to his lieutenants to buy the stocks. They I think are maxed out. They were only given a certain amount of cash originally.
Right.
And
the whole point is how does Buffett administrate the whole thing, right? We don't know.
Hey, we don't know exactly, but it doesn't seem, based on their buying of the equities, that he's given them any more money.
Right. And you got to ask yourself why Charlie is just sitting there going "Oh, I don't understand chips," and not helping him understand where the allocations need to rise for the other guys, right? Right. Exactly. Really,
yeah.
Charlie, you fund Caltech, but you don't get the chip stocks? Really?
Well, and not to mention all of his own personal investments over in China and the EV industry and stuff.
Yeah, come on, man. That dude understands this stuff. He's a mathematician. He's been out here for decades. And again, he's an older man. I understand that, but that his brain works. He's an articulate guy. He can figure this stuff out. For whatever reason, trying to get Buffett around in this is just not worth the time, right? So Buffett, it's okay, I do it, but it's not worth the time. The guy's not going to do it. I just, I'll get a paycheck anyway, so I'm not going to deal with Buffett.
Yeah. All right. Well, that's something to watch for 2022. We don't know what's going to be happening, but we did talk about a lot of stocks on this episode. So on the chip side, Micron is MU. AMD, we mentioned that. NVIDIA, NVDA. I mentioned United Rentals, URI, for the infrastructure play. We talked about a couple of the housing stocks. KB Homes is KBH. Lennar is LEN. Toll Brothers is TOL. Polte is PHM. Mohawk Industries, MHK. Whirlpool, WHR. We mentioned that one. John mentioned Wesco, WCC. And then we did just talk about the security stock. We had RDWR, CrowdStrike is CRWD, Palo Alto Networks, PANW, QLYS, how do you pronounce it? QLYS? QLYS. Yeah, is that one. And then, we did talk about the Russell, the mid caps. You can buy ETFs for those. And Berkshire Hathaway's BRKB, unless you really want to go for it and buy those A shares, when it's BRKA for the A shares. So there's a lot going on, and 2022 is going to be very interesting. And we still have a couple more podcasts here in 2021, so you don't want to miss a single episode. Get us all on Amazon Music. We're on Spotify, Apple Podcasts, and on SoundCloud. And as always, I'll see you again next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.